Boom, we are alive, ladies and gentlemen. Thank you for joining us today. This is Tiho and the Arcane Bear. We're going to be going over some fun analogs today. In general, I think one of the most important parts is to keep macro perspectives on investments. And because of that, we're going to be doing some macro perspective outlooks. So to start today, remember to give us a thumbs up and subscribe to this channel if you're new. We're going to roll right into TradingView where we were looking at yesterday. So here we are. This is a daily chart. It shows some of the similarities between the 2014 to 2017 accumulation cycle at the bottom here and the 2017 to 2020 accumulation cycle in the top. Now, one of the unique aspects of this, as we've gone over, is something in mathematics we call scale invariance. And what that means is that no matter what area you look at something, you're going to see these repeating patterns over and over again. Now, a lot of people have started to talk about the 200-day moving average. And we're going to show that here with one of our free indicators that you can download by following us on TradingView called the Bear Claw. Now, the Bear Claw is a stack set of EMAs and simple moving averages. So the green represents the simple moving average at the 200-day, and the blue is the 314-day simple moving average. So obviously one of the key distinctions we can see here is that on the first bounce of reaccumulation, at this, again, a similar time frame here, we couldn't even break through the EMA itself, and we jumped right back up. So again, one of the big differences between this bull market cycle and the previous one is the amount of overzealous leverage traders. Now, again, I don't recommend you ever trade using leverage because it's a very easy way to lose assets. And if you're smart about perspective modes of accumulation, you should understand that you definitely don't want to lose assets. You're better off just buying them year over year over year. For example, one of the first times, not the first, but one of the first times I was still buying Bitcoin, I bought at what was at that moment the all-time high of $1,000. And had I gotten removed from the situation there, I would have not been able to keep my assets. And what looked like the all-time high, oh my God, you bought Bitcoin at $1,000, it's now down at $200. You failed, you lost money. No, I kept accumulating more, and it allowed me to continue my accumulation process. And now with Bitcoin as high it is, those were all great entry points. And effectively, if we assume that in the future we're going to see some type of continual accumulation here, that is the same story. Now, I want to go over a few analogs again here because this is comparing the 2018 to 2020 and the 2014 to 2018 accumulation cycles. And I would also like to go over this one as well. I thought was nice. This is the 2010 to 2013 accumulation cycles compared with today, the 2017 to 2020 accumulation cycles. Now, one of the things I've talked about is that I suspect that this moment that we're about to see is probably a kind of a long, drawn-out accumulation cycle where Bitcoin bumps around between the $30,000 and, let's say, $42,000 area, effectively making the average investor bored and walk away. So I do not actually believe that this is the bear market cycle. I believe that this cycle is designed right now by the bigger players to get rid of all the small players by boring them with basically sideways price action and all of this nonsense talk on Twitter. So again, we've been studying the Wyckoff accumulation ranges for quite some time, so much so that we have our own schematics drawn out here. But this is what I wanted to go over. I thought this was kind of funny. Please be sure to follow us on Twitter. This is what Twitter's technical analysis looks like right now. There's a lot of confusion. You see turn, run these directions. You got two signs pointing left and one sign saying don't turn left. It's very confusing. And this is basically what happens. And the point of this moment is to design the average retail investor to be confused and basically want to walk away from the longer term investment strategy. So again, analogs like this look very well primed to show us that in some degree, I suspect that we could be waiting maybe even 2 to 3 months in this kind of sideways accumulation range. And again, this will be designed to get rid of the average retail investor, to shake them out of their positions, to take losses, to make an entry, to get stopped out, to do silly things while the bigger whales continue to accumulate. Now, we would be very kind to note that, again, we've been watching these for quite some time. The Wyckoff accumulation ranges that we have drawn here we have not changed this pattern since we started drawing them in basically March, April, May. So you can go back through all of our videos where we've been studying Wyckoff, and these regression lines and the Wyckoff accumulation ranges we've had stacked since May. Now, one of the key points I think to keep in mind is that right now we're accumulating between the previous automatic rallies regression line and the buying climax regression line here and here. And I suspect that we'll probably spend 2 to 3 months in this area. Now, a lot of people are wondering, oh, is the bear market over? Or is that it? Is it going to drop all the way down to $20,000? And although that's an opportunity, well, here, let me say that again. That's an opportunity, right? For those of you that were like, oh my God, I didn't buy Bitcoin. I bought it at 60 grand. I didn't buy it at 20 grand. If you, again, take the investment thesis, and let's even use 2017 as an example. Let's say you bought the 2017 high of $20,000, right? Instead of thinking that you lost money, what you should recognize is that you actually started to build a portfolio. You just happened to get the first step wrong. Now, the best way to do that is to compensate by continuing to accumulate the asset for the reason you thought it was valuable in the first place. This is one of the reasons why I consistently say what you should do is focus on understanding the value of an asset and basically ignore the price. If you do that, you will be a long-term successful investor and often way more successful than the average retail trader who usually gets washed out and walks away in a very short period of time. So the same thing goes here. If we go back, what I would like to do again is take a look at these cycles. Here again we have the December 2017, and another analog here would be 2010 to 2013. And I do suspect that we're going to get a multi-month sideways movement to basically make everybody bored. Right now, this confusion that we see in the Twitter world is the exact purpose of these intermediary reaccumulation after decline moments. They are designed to get rid of weak hands and make them bored and confused. You will be kind to note that $1.5 billion of Bitcoin went into Tesla's holding tank on around $31,000. There's a pretty serious floor near this area, and although we could come down to $20,000, that should, in any good investor's mind, represent an opportunity, not chaos. And this is, again, often what people get wrong, is that they look at the downwards potential as chaos. So let's say we go to 20 grand. Fucking awesome, right? That's actually not a bad thing. It would give us more time to accumulate. Now, I don't think that's going to happen. I still believe we could see a retest of the $30,000 area, and we've gone over this. If we look a little closer on our 45-minute chart, you will see that we've been charting what I believe to be turning into a new accumulation after decline cycle. And again, this can be nicely highlighted by our Arcane Bear accumulation ranges. So you can see that there is a direct similarity between Wyckoff accumulation schematic 1 and where we are right now. And again, this is going to be designed to basically bore investors. So here, we're probably going to have a jump down to around $30,000 to $28,000, strictly designed to bore people. So here we go, up, 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 up. We'll probably sneak down into 31,000 for spring and continue to move forward, probably closer to August. So and maybe it will happen sooner than that, but nonetheless, what I believe right now is not a redistributional phase because of the other analogs that we're seeing of where we are in the market, both in 2010 to 2013 and in 2017 to 2020. These accumulation ranges look almost identical. And again, this is the importance of the fractal and invariant scale nature of human psychology, is that you cannot escape the universe. Everything exists within the universe. So someone shared this one yesterday. I was glad they were able to put this together. This is a function of scale invariance. This is what I was talking about yesterday, is that everything in the universe has repeating patterns that exist within themselves. And no matter how far you zoom in and or out of these patterns, you get the repetitive cycles. Again, I suggest reading books by the famous Benoit Mandelbrot, The Misbehavior of Markets, and understanding that what we're witnessing right now is a fractal version of nature itself. This is why you get such beautiful analogs between 2010 and 2013, as well as between 2018 and 2020. These repetitious cycles are significantly bigger than you will ever comprehend. It is important to remember that the markets themselves have been around longer than you and will be here after you die. That means the market's speculation and human nature have existed for time beyond your own little life form. And that's very, very, very important to understand, because then these analogs start to make a lot more sense. And more importantly, you can start to become a much better investor, because you can recognize that there is these long-term periods of accumulation of these 1,000-day cycles where you can do nothing but buy and wait for the upside and then reduce risk. Right now, I do not believe we're at the end of this bull market, but look, it will end one day. And you should know what to do as a strategy for an investor on the long term, because that's where the hundreds of millions and billions of dollars are made, on the long-term accumulation cycles, where for the entire time between February 2014 and January of 2017, you could have been buying Bitcoin for approximately between $200 and $800, which seems fantastic. And even still, in 2018, you could have been buying Bitcoin somewhere between $7,000 and $3,000 for over 1,000 days. That's important to remember. And again, this is why I think scale and variance is such a formidable function to understand of the way the markets react, is because right now, whether you're at the small little fern or the extension of the universe, you have time. Anyways, I think that is a really important function to understand, ladies and gentlemen. And so, hey, follow us on Twitter, because, you know, that's smart. And also understand that these cycles repeat themselves. They are infinitely bigger than your ability to comprehend. Look at the universe here, bigger than you can comprehend, yet they show up in the smallest of forms, like the fern or the shell, the nautilus shell, or the sunflower seed, or the repetition of what appears to be an agave plant growing on here. This is the way the universe works, and the markets do not escape the universe. The sooner you realize that by doing your study, by going through books like Dan Dow, 100 Beggars by Christopher Mayer, or by reading the book The Misbehavior of Markets by Benoit Mandelbrot, it will make a lot more sense how you make millions of dollars through the investment cycle itself. And pictures like this, I think, are extraordinarily relevant. Okay, let's take a quick look at a few of the other ideas along the board. Now, I wanted to go over, actually, let's start with the S&P 500. First off, we use the traditional markets to measure general sentiment in the rest of the investment world. Right now, we are actually closing above the point of control and apparently moving towards the top of the box for the S&P 500. I believe this is another bullish signal for our market space. Even more importantly, the NASDAQ itself, the other day, while I wasn't looking, it broke through our barrier, and we are in new all-time highs for the NASDAQ. This is extremely important to remember, that our market does not exist by itself. When the rest of the tech sector and the S&P 500 and the NASDAQ starts to show these bullish indicators, it is very likely that our little market will pursue the same goals. We're going to use Matic again here as well, which is showing an extraordinary amount of power, bouncing right off the top of our box, jumping up 150%, 200%. What an amazing day trade that was. To again increase the market position here, you're already up 150% within less than 7 days. And the strength of the general markets is quite strong. Now, 1 inch here I want to use as an example, because it could very clearly be looking like a distributive market. And yes, look, again, what we need to remember is one of the first times ever you have retail getting into products that are effectively venture capital, with a lot of volatility and liquidity that you would never have had access to as the average Joe Blow Schmo. This is an opportunity, and although the volatility might make you feel a little weary, if you really truly understand the idea of Dan Dow or Wu Wei, you will recognize that heads I win, tails I only lose a little is an extraordinarily valuable function. We have been investing in Matic since it was a penny, right? So a $10,000 investment in Matic would be worth around approximately $1.5 million in the last year. That is extraordinary, right? That means $1,000 would be worth around $140,000 of an investment in the last year alone. So yes, we are up high, but venture capital has this asymmetric potential to it. So that means there is volatility to both the up and downside, clearly just demonstrated here with Matic, where we were up at $2.40, came down to 84 cents, jumped right back up to $2.40, and have now found a middle ground between around $1.90. that's the volatility that takes place in any asymmetric bet. And you should, again, repeat to yourself, heads I win, tails I only lose a little. A good investment strategy is not to try to bet everything on Matic, but to note that a $1,000 placement over the course of 5 years, it may yield you hundreds of thousands of dollars, if not millions of dollars in return. And that's what the Arcane Bear has been duly focused on for a long time. We believe it's important to understand that these functions of time, the nature of the universe, the repetition of cycles that are far greater than you could ever imagine, will continue to repeat no matter what you think. And this is why people so often get markets wrong, is because oh, it's manipulation. Look, you cannot escape the universe. No matter what happens, you are part of the cause and effect of the waves that are significantly bigger than you, and you cannot control them. The sooner you recognize that, the more valuable your portfolio will grow, because you'll understand you are part of nature and you'll be able to invest with its function and style. So 1inch actually dropped some news today. I'm going to go ahead and share that. So they've partnered with Mercurio, and they've got this great wallet as well. So they've provided new on-ramps for the DeFi sector, so people can buy with fiat, accumulating some of these. And again, one of the things I think that's most important is that when you start to see these on-ramps for the average retail investor, it really brings a unique form and function to this space. People around the globe have not yet recognized that they can send money for a fraction of the cost around the world that is better than PayPal, it's better than Google Pay. And this is why big companies like Apple Pay and Google are working tirelessly in the background to learn how to integrate these products. Now, one of the important things to remember here is that the further you go when you look into this, yes, now you can do that via the 1inch app on Apple Pay, right? So this is extraordinarily valuable, and you can swap tokens, you can jump back and forth. And this is ridiculous to see that, again, these are asymmetric bets, right? So you should never be trying to bet everything on 1inch. But a $1,000 investment here over the course of 5 to 7 years may yield you that 100 bagger return. And that function is so important. I promise you guys, don't listen to people like me. Go listen to Christopher Mayer's 100 Baggers, okay? I'm going to show you this book one more time. The stock returns of 100 to 1. So for every $10,000 you put in, you would get $1 million back. This book goes over the last 100 years of companies that would have done that, and approximately how long it took for those companies to return these levels of exuberant, like ridiculous investment returns. So understanding that it takes time, finding the value of these companies, knowing that you're in a venture capital sector, that there is volatility. Some of these projects could fail, right? So that you're not going to get all of them right. You find the ones that you seem to be more successful and you invest in those consistently. Now, the reason why I recommend this book is Christopher Mayer. Go watch this. Christopher Mayer net worth. Okay, let's find out. This is actually wrong. He's a billionaire. Oh, no. Apparently he was worth only $103 million before he died. I may have gotten that wrong. So I thought, as my bad, only hundreds of millions. This is the wrong guy. Jesus. We're just going to skip that for now. I'll make sure I have data loaded, more importantly, every time we go over it. So again, let's summarize. I believe that for Bitcoin, we are in a reaccumulation cycle. I think it's going to take probably 1 or 2 months to really wash people out. It's going to scare them. We're going to rip down to like $28,000, $29,000. And again, this entire market moment is designed to get rid of the average investor who does not understand that market cycles take time. They're way bigger than they are. And when you look at these repeating functions, you will know how to invest properly. Anyways, I hope you guys found this valuable. This is Teal with the Arcane Bear. Give us a thumbs up if you like this content. I'll spend the last few minutes kind of going over the questions any of you guys have. Flow with Close says, Teal, I would love to learn more about all the crazy colors in your charts. What are they helping you see? So right now, guys, and woman, I guess Chloe is definitely a woman. So, ladies and gentlemen, right now what we're using, this one here is a stacked EMA. This is called a bear claw. This is one of the free exponential moving averages and simple moving averages that we give away for free if you follow us on TradingView. Again, I try to actually suggest removing a lot of this data. I like to simplify my charts and my understanding. That's why we look at these much larger macro cycles with no volume, just general price indication, and we compare them to something like this, the repetitional cycles of the universe that are bigger than we can comprehend. Because when you start to add too many things, first off, your chart looks ridiculous. Like, let's say I start to add all of the things I have on this screen. Look how dirty this becomes in a very short period of time. It's very difficult to tell what's valuable at that point. Again, I think it's better to generally go with less information. It's generally easier to make a clear distinction between them. And just from another relevant point I wanted to go over here that I think I forgot is the reserve risk ratio here for Bitcoin is actually quite low. Right now, we're at a comparative price of accumulation that we were back when Bitcoin was at around not $12,000. So the approximate risk ratio right now for Bitcoin's accumulation area is that in which it was back in 2019 at around 12 grand. This is basically Bitcoin at 12 grand if you remove the price and look at the risk ratio. So again, for those of you that don't know, the RR is using a measurement of how many people are long-term holding Bitcoin and the amount of Bitcoin that is on the open market at any particular moment. One of the other ways we like to look at this is the percent of balance of the Bitcoin on all open exchanges. And as you can see, we did peak out at the last drop at that negative moment of around $28,000. And we do see that there's been a little bit more market volatility coming on, but nowhere near the levels that we saw in that very short period of time. We have seen a consistent decline in that open supply, which means that the open supply has been being bought up by larger interests. I think probably one of the interesting ways to look at this again would be to see the potential. So we've actually seen an increase for the first time of accounts over 1,000 holding Bitcoin in the last 2 weeks as well. Another strong signal that we are not done this market. The accounts of Bitcoin holding 1,000 for the first time has increased back since January. So I believe we're still in an accumulation cycle. It's just going to draw people out. It's going to confuse them. It's going to drag them along. It's going to try to push them out of their positions so that they can push the markets higher one last time. Again, before we start, what will likely be a much larger market downtrend cycle, probably near, let's say, December. So just my little thoughts and updates. And for you, Chloe, there, I hope that was helpful to understand that generally, even though I have all these other indicators, I think it's more valuable to work without them. But the one I was using, you can download for free by following us on TradingView. It is called the Bear Claw. So again, you could go to Arcane Bear. You could follow us if you go to tradingview.com. This is how we use all of our charts. You could go to scripts. And here is the Bear Claw. We've got 466 likes on our Bear Claw. Wow, that's pretty impressive. So thank you guys all. You can download, again, these scripts for free. Anytime we produce scripts, they will be available for free for you all. So if you follow us there on TradingView, that's where those are available. But again, more importantly, if we look at the S&P 500, up, closing above the point of control. The NASDAQ, new all-time highs. And just for fun here, let's finish off with the VIX for today. The volatility index, measuring the general uncertainty in the markets as a whole. We have again crossed below our long-term trend line since the pandemic started. So I think that this is a valuable function to understand, is that right now the fear in the general markets is actually still decreasing. And we could make an argument that we aren't below the long-term trend line if I move this around a little bit, but we are still on the downside. I suspect that most of it is most of the fear of the retail investor has been pushed out of the markets. And I suspect that what we are witnessing, as we've gone over this many times before, is a beautiful accumulation schematic. So keep that in mind. It's Tio with the Arcane Bear. Thank you all for joining us today. I really appreciate your guys' support. We'll see you guys again on the next episode.